Large U.S. banks reported strong earnings for the first quarter of 2018. While earnings benefited from lower taxes due to the Tax Cuts and Jobs Act, there was also top-line revenue and pre-tax earnings improvement. Fitch estimates that the median reduction in effective tax rates year over year for the 8 largest bank holding companies was 8%, a total savings of roughly $3 billion in tax expense for the first quarter. The tax benefit, however, was muted in the first quarter due to a change in accounting for employee stock-based compensation. Going forward, Fitch expects bottom-line returns to be higher due to lower effective tax rates. Lower tax rates are not the only driver of strong earnings this quarter. Pre-tax earnings benefited from higher interest rates, solid cost controls, and a sustained benign credit environment, which drove single-digit revenue growth for 15 of the 19 largest U.S. banks. Most banks also reported an expansion in net interest margins with rising interest rates. The 5 large global trading and universal banks reported strong capital markets revenue, which also boosted earnings. Capital markets earnings were driven by robust trading results. Market volatility in the first quarter boosted equity trading revenues in particular, though fixed results were also strong. However, the first quarter is typically the strongest quarter of the year, and it is unclear if the added benefit of market volatility will continue for the remainder of 2018. Investment banking activity was the weakest link in capital markets activity, and future performance depends on whether corporate M&A activity picks up, which will depend to some extent on whether the greater certainty around tax reform will outweigh potential macro issues. Going forward, Fitch also expects that deposit betas will begin to accelerate, though they still remain quite low despite the rate hikes over the last year and a half. As this trend emerges, some net interest margin compression is likely. Loan growth ticked up 4.5% in the first quarter of 2018 year over year. Strong credit card lending and a notable increase in commercial and industrial lending drove the growth. Commercial and industrial lending grew 2.6% year over year, which was the strongest growth in 5 quarters, though well below long-term averages. Fitch believes corporates are still digesting the impact from the Tax Cuts and Jobs Act, and therefore a return to normalized commercial and industrial lending is delayed. Commercial real estate loan growth has continued to slow, a trend that has been ongoing for more than the last 5 quarters, with some large banks showing contraction in the sector. Management teams pointed to continued competition from non-bank lenders as well as consistent access to the capital markets for commercial real estate borrowers as the driver for the slowdown. Auto loan growth has also slowed, while credit card growth has continued, a trend we expect to continue. Rising rates, however, may also contribute to slower loan growth going forward.